$1 trillion. That's the amount of Chinese capital that was once invested in American companies, spanning everything from Hollywood studios to Wall Street banks. But today, that financial floodgate has been slammed shut by Beijing. No warning, no room for negotiation, just a cold and decisive move. Now, U.S. executives are scrambling to figure out why this flow of money has been cut off. But the issue is much more than a simple policy shift. This could signal the opening salvo in a broader economic war, one that's evolved from trade disputes to tech rivalries and now to full-fledged capital conflict. This development could have serious repercussions, from layoffs to rising consumer prices. So why did China make this move? And what is the real aim behind it? Let's break this down. This wasn't an emotional or impulsive decision. It was a highly strategic one. The Chinese Ministry of Commerce quietly altered its outbound investment rules, categorizing all non-essential capital flows to what it considers hostile jurisdictions as suspended, effective immediately. The United States is now officially on the list of these hostile nations. On March 17, 2025, China's State Administration of Foreign Exchange issued an order halting all investments in U.S.-based companies, citing concerns about geopolitical risks and asset security. There was no grand announcement. The move was buried in regulatory filings, only surfacing through a Reuters report days later. To put this in perspective, Chinese investment in the U.S. had already dropped by over 95% since 2018, falling from $46 billion to just $2.3 billion. And now, with this freeze, that number is expected to go to zero. According to Professor Zha Dao-Zhang from Peking University, this move is a calculated strategy to apply maximum pressure on the U.S. financial system. What's even more worrying is not just what China has stopped investing in, but where it's now directing its capital. If you think this is merely a temporary freeze, think again. This might be the beginning of a full-blown financial siege. While trade still flows between the two countries, Beijing has been gradually decoupling from the U.S. economy piece by piece. In 2024, China sold off $14 billion in U.S. treasuries, its largest single-year reduction since 2016, bringing its total holdings down to $775 billion, according to U.S. Treasury data. At the same time, Chinese state banks stopped conducting dollar-based transactions, with U.S. banks under new compliance rules from the People's Bank of China. This shift in strategy has left Washington increasingly vulnerable, as its primary financial tools, export bans and tariffs, are proving too slow and too ineffective against China's capital flight. The effects of these moves are already being felt. In 2024, foreign direct investment into the U.S. dropped by 22%, with projections for 2025 showing an additional 19% decline. While Chinese capital was the most visible absentee, it wasn't the only one. Norway's sovereign wealth fund, for example, divested $7.1 billion from U.S. tech stocks, citing regulatory uncertainty. Similarly, Japan's GPIF, the world's largest pension fund, cut its exposure to U.S. commercial real estate by 30%. With $4.1 trillion in U.S. corporate debt maturing by 2026, fewer foreign buyers are available to roll over this debt, forcing American companies to look inward for funding at much higher costs. This isn't just about capital pulling out, it's about a tightening financial noose. As traditional sources of equity investment and bank loans retreat, American companies are increasingly turning to high-yield debt. In 2024, over $430 billion in junk bonds were issued, 38% more than the year before. The average yield on these bonds has climbed from 5.2% in 2022 to 9.6% in 2024. Take the example of Hartwell Tech, a Boston-based manufacturing company that saw a $180 million equity round from Chinese investors evaporate overnight. Desperate for funding, the company turned to Apollo Global for emergency financing, accepting terms as high as 11.3% interest, secured against intellectual property and physical assets. Fitch Ratings has warned that 20% of U.S. mid-cap firms now face an acute risk of not being able to refinance their debt within the next 18 months. Many are being forced into short-term financial arrangements that prioritize survival over long-term growth. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. You might ask, wasn't the U.S. supposed to be insulated from all this through reshoring? Under the Trump administration's 2025 executive order, tax credits were expanded to encourage U.S.-based manufacturing and the rebuilding of critical supply chains. But the National Association of Manufacturers reports that 62% of firms planning to expand within the U.S. now face funding gaps, primarily due to the lack of foreign partners. High-profile projects that had partial Chinese or Taiwanese financing, such as the $8 billion battery plant in Michigan and the $3.1 billion robotics hub in Nevada, have either been delayed or scrapped entirely. Even the CHIPS Act, which was supposed to ensure America's semiconductor independence, has been diluted. Intel's $20 billion project in Ohio, designed to showcase U.S. leadership in semiconductor manufacturing, recently paused its second phase due to funding delays. But the real consequences will hit home when consumers start feeling the pinch. The Trump administration's expanded tariffs now apply to over $500 billion in Chinese goods, with average tariff rates hitting 22%. As a result, the costs of consumer electronics, home appliances, and auto parts have soared. Appliance prices alone rose 16.7% year-over-year by the first quarter of 2025. Major retailers like Walmart and Target have issued warnings about shrinking profit margins directly linked to these tariff increases. The National Retail Federation estimates that the average American household will spend an extra $1,950 on goods by the end of the year. This is more than just a strategic pivot. It could be the first phase of an ongoing campaign to redraw the rules of global finance. By redirecting capital flows, building alternatives to the dollar, and leveraging its growing influence, China is quietly positioning itself to dominate the next financial era. If this strategy works, the U.S. may find itself struggling to maintain its global economic leadership. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way.